Hi everyone, this is Mayank and welcome back to my channel. So today we'll discuss about one particular stock which has been a multi-bagger, and I see personally a lot of potential in the stock because of management commentary. A lot of capex is going on and the capex almost over. So we can start seeing the rally, or we can start seeing the increase in revenue from next quarter, maybe like that. But still I'm saying this is not a recommendation. So please either you watch the video and then you do your own research and then you decide whether you want to invest in this particular stock or not. We are going to talk about Usha Martin. So basically, Usha Martin, what it does. So Usha Martin is basically a player in the wire rope segment. The history of the company. So company is 60 years old, and there are 6 manufacturing facilities, 30 plus distribution centers, and around 3,268 crore revenue they did in the last year, with a profit of 351 crore, 21.2% ROC. Around 3,100 employees they have, and their presence across 6 continents. But if you see, this company has gone through a turnaround. So right now they offer specialty wire ropes, high quality wires, and LRPC. But before this company has gone through a turnaround factor, where they divested their steel factory to Tata Sponge, which is a subsidiary of Tata Steel. So this is the turnaround part, where this divestment of steel business resulting in sharp deleveraging and reshaped balance sheet, and then the focus on wire rope, specialty rope business, and now they're into a growth factor where their rating is very good, their profitability is very good, and they are a niche player with 70% market share in India itself in this particular specialty wire sector, and they are present in many countries. And if you see here, they are a company which has lot of strongholds. They have one of the strongholds going through a multiple capex. We'll discuss this in screener. So they're going to around 350 crore of capex, which is almost over. In the fourth quarter, they are saying that it will be over, and we'll start seeing the result of that. And from the management commentary perspective, they are very much focused on how they spend their money, capex, and then employee salary and all those things. They're very much prudent on that part. Okay, and they're expanding internationally. Their presence in US, their presence in Europe, their presence in Southeast Asia, their presence in Middle East as well. So they are quite focused company, and they are doing a lot of digital initiatives as well. Around 60 crore they're spending on digitization of their entire process and entire factors and everything. So overall, this company has good thoughts on how to grow the business. And then when you go further, we see what this company does and everything. So this is the highlights of revenue. Probably I'll let you do all these readings, because this is again numbers. This present everywhere. Screener also is present in this presentation also. We'll use this presentation to only understand what this company does and what are the future perspectives and everything. In terms of product, they have wire rope, which contributes 69% of the product. Then they have LRPC is 13%, wire and strand is 9%, and some other key fitments they do, which is 9%. So when you say wire rope, so this is the specialty sector. So if you see cranes, if you see construction machineries, if you see engineering machines, so those machines use a lot of wires, which are used. If you see, those are very fat steel wires. Okay, so some of them goes up to 200 tons, 300 tons, one single rope. So this company specialty, they create this kind of ropes, and these ropes are not created for only one company. Like same rope cannot be created for every company. This differs from product to product. So they create a bespoke solution, and they create a custom rope requirement based on the client's requirement. So this is why this company has a strong hold, because they can customize the product based on the client's requirement. And LRPC is 13%. It's a low volume, but again very less margin. LRPC is the basically, if you see the roofing of a RCC building, you see the rods are tied by a small wire. It's not that small, it's comparatively small, but those wires are called LRPC. They can be bended, but not to an extent that it becomes like thin wire. Then they have wire and strand, normal wires. Then they have 9% key fitments and all. But their strength lies in wire rope, and this also contributes to majority of the revenue. Industry wise, their presence is 22% revenue comes from engineering industry, 14% from construction and infrastructure, 21% from oil and offshore. Crane, they give 14%. They'll give a lot of wires to cranes. Then auto, elevator, utilities, mining, fishing. You can see the percentage over here. And then geography wise, the presence is India's 45%. Then next comes Europe 24%, Asia Pacific 15%, Middle East and Africa 10%, and America is 6%. They are growing. They are trying to grow a lot in America as per the commentary, because America is doing good in terms of economy, and they are trying to get a good market hold in terms of America. Europe also, they are trying to do get in hold of market, but since the economy of Europe is struggling kind of thing, so they are also struggling with them. But again, saying that the company's position in Europe is relatively better, compared to other companies. So we can hope some good turnaround when the economy gets in shape in Europe. So here you can see wire rope segment's contribution to overall revenue increased to 69% in first half of 24 versus 67% in the FY23. So it's not a huge jump, but again it's an improvement. While in wire rope, the value-added segments, crane, oil and offshore, elevator, mining, fishing, share rose to 70% in first half FY24 to 65% in FY23. As I told you, these things are very much custom made wire ropes, and so this creates a lot of margin for them. And since their segment contribution is increasing, so eventually it increases the net profitability. The share of international business stood at 55%, with international operations according to year and Y revenue growth of 3%, which is not great in terms of number. Profitability indicators remain strong. So they have ROC was 19.2% in 22, then 23 it was 21.2%. June 2023 it was 22.7%, and now September it was 23.8%. And they want to maintain the ROC at this level around 25%. ROE you can say 18.8% to 21.4%. Then asset turnover ratio is right now it's around 3.2%, which is quite consistent from last 2 to 3 years, which is good. They want to target a asset turnover ratio of around 4%, around 4x, what they are saying. Management commentary. These things you can go yourself and you can read its all numbers. Now their price is basically a lot directly proportional to the price of steel. So if you see, the price of steel was high in the case of quarter 1 FY23, quarter 2 FY23, half of FY23, and similarly their EBITDA per ton was also less. Then when the price of steel dropped, then you can see the EBITDA per ton also increased. So their margin and their profitability is directly linked to steel price, raw material of the steel. So this is what we need to keep a track of. If the price of steel goes high, you will definitely see a margin erosion for this company, because they produce the products which is directly made out of steel. Okay, so this is about the company. Profit before tax bridge and all you can read and go through yourself. Okay. Then we'll go through one more important factor, that is we'll go to the Concall letter. We try to understand how these things entire hot management is trying to portray, and how they are trying to go through the situation which is happening right now. So this is all the numbers, how sales volume of wire rope, sales volume of wire and strand, LRPC and all. So if you go through the entire thing number by number, probably the video will go around 50 minutes or 1 hour. So that is something which I'll try to avoid. One important factor here is the credit rating of this company has improved from BB plus to right now A, after this turnaround factor which happened was selling the steel plant, and they are also forecasting that they want to reach A plus rating going in the future. So this is one part. Now if I go into management commentary, then here you can see, so they have couple of units in US, Europe and Middle East, and as well as Southeast Asia. In the Middle East, they have acquired a partner with a company called Brunton Shaw, and now it's called Brunton Shaw in Usha, and they have a company called in Thailand Usha Siam, right? So Brunton Shaw and Usha Martin India works together, and the product is manufactured by Usha Martin. They have plant in Ranchi. They're investing a lot in Ranchi. All the capex are going in Ranchi, so that the product is manufactured at Usha Martin India, which is Ranchi, and then they will transport or they will ship it to Brunton Shaw, and they'll sell it in US via Brunton Shaw Usha, which is a merger company where 60% is there with Brunton Shaw and 40% there with Usha Martin. So this is one thing. Then they are trying to do a lot in the US also. Here you can say US market is definitely, this is what they are saying. US market is definitely important for us. In the first half of the year itself, we show good growth in the US, especially on 3 key value-added segments that we are targeting. One is the elevator rope, for which we did an increase of over 50% in volumes compared to the first half of last year. So they are trying to focus a lot on the US. In crane ropes as well, we are able to double our volumes. So US is very important market for them. Then they have a good market in the Europe as well. So if you go further, somebody asked that whether they want to focus on Saudi Arabian market. So yes, definitely. Like you mentioned, Saudi is a growing market, and we do plan to increase our presence in this market for sure. And the area what they want to target is oil and gas sector, port sector, as well as crane ropes. So these are quite oil and gas is quite prominent in Saudi or Middle East, I'll say. So from that perspective, they want to focus on oil and gas. Then few questions if you see later on, then they have a question regarding where they want to deploy their entire capex. So the question was the capex plan, the phase 1 expected to start in Q3. So is that on time? How is it? So the Usha Martin, they are saying the Usha Martin Ranchi plant, in which we have put a major part of phase 1 of the capex, is a brownfield expansion of our Rachi plant. So this is a combination of adding additional manufacturing equipments, both in wire drawing, stranding, closing, and also increasing our packaging facilities to enhance the volume. While most of the equipments are almost in the final stages of commissioning, one important furnace which will help us to increase the volume is getting commissioned in January. So I would say that we will be able to complete all of it and start getting the benefits of that from quarter 4. So as I told you, quarter 4 they will start getting the slowly the increase in capacity, and then the more they sell, the more margin they get. So now the capex is almost over, and then we'll start seeing the business coming out of that capex. So this is all about there are further things mentioned in this particular thing, how their steel price is related to their EBITDA per ton, how much they are selling. So those things you should go through this later, and then probably understand more about this company, because you can have to do a research before you purchase the stock. And if you decide to purchase the stock, and to do the effective research, you need to go through this con call letter, go to the presentation, then to go to the screener, which will go there, and you can see now. So you see the screener. So there it's a mid cap company. Their ROC and ROE is good, we discussed. The stock is 23.9, which is on the higher side compared to what this company has been doing in past. But the kind of growth this company is doing, this doesn't look that it's very high PE. Debt wise they have 423 crores, but a lot of capex is there, so this debt you can see. But again, if you compare the past, this debt has reduced a lot of because of deleveraging, and net profit is 351 crores. Okay, and then one important factor, we'll see the capex part here. Go to balance sheet. In the balance sheet, if you see, the 139 crore capex was there, and then they have 210 crores still capex is there. So a lot of capex are going on, and as we discussed before, this capex will be get over by quarter 4, and then we can see the results. And if you see here, debt borrowing, it was almost 4000 crores, 3565 crores. Once the plant got sold, it was 620 crores, and now it's reducing to 423 crores. So year on year, quarter on quarter, they are reducing their debt, which is a good sign. And their debt to equity ratio is almost 0.16, is the debt to equity ratio, 0.2, which is very much in the comfortable zone. So this is how the company numbers looks like. It's a very comfortable position. You got shareholding pattern. Promoter has been selling their stocks in very small numbers, but still they are selling. And public is also reducing their percentage from 42.37% almost 36.6%. But the best part is that all these stocks what they are selling, they are consumed by the FIIs and DIIs. So FIIs has increased their holding from 8.83% to 12.03%, where DIIs increased their holding from 0.83% to 3.86%. So this is a good thing that money is moving out from the small investors to large investors who stay invested in the stock for a longer period of time based on fundamental basis. So this is a good sign. So the overall this company is doing good in terms of investors interest, in terms of capital expenditure, in terms of their focus on spending money. And this is the reason why I want to discuss about this stock. And as we discussed, the turnaround is doing good, and they are focusing into the specialty products, not in regular products where there is a huge competition and the margin erosion gets in the factor. There is a price war. They want to become specialty company where they don't want to go in the price war zone. So this is about this company. Technical analysis, if you go and check here, then probably you'll see that this company was doing good. It was almost a 30x return. If you see from before COVID, it was around 20 to 18 rupees, and now it went up to 375 rupees. So it's almost 30, if not 30, it's 20 bagger. So it's a huge return. And then post that, this stock is kind of consolidating on the same thing, because nothing tremendous has happened. But since this capex gets completed and its entire thing comes in the picture, then you will see suddenly the revenue will start increasing, the profit will start increasing, and then we can see a good up move from here. So this is where I'm betting on. If you see Federal line over here, this is a thing where kind of a range. So here, and then if we see here somewhere like that, if you click on here, then this is kind of a range where this stock has been doing for some time, not a long time, but almost 6-7 months. But once this cross this range, and this happens once the capex starts reflecting, and then we can see a rally from here. So this was about the stock. If you find this video helpful, do like the video, and do share with your friends and family. Thank you so much for watching. Stay happy, stay safe. अब बंद कैसे होता है? इतना बड़ा हल्ला करते हैं भाई साहब, परेशान कर देते हैं।
सही टाइम पे बना लिए थे।